South Asia Committee of the International Law Section presents the Global Lawyers Summit in association with CNBC TV 18.
Today, the topic of our session is public M&A, deal considerations and trends. Doing M&A is very challenging, and doing public M&A is even more challenging because it's not just the Companies Act, the exchange control regulations, or the sector-specific regulations. We also have the entire gamut of SEBI-related legislations to take care of, whether it is takeover, insider, LODR, and the like. And this kind of complexity and challenges is what makes interesting for us practitioners in this space. And today I have with me a very distinguished and diverse panel to talk and share views on what they see in this space, in their experience, either as advisors to boards or as in-house counsels and as practitioners as well from India and abroad. So let me quickly introduce you to our esteemed panel before we move on. Starting from my left, we have Mr. Chintan Thakur, who is the CFO and Executive Director of InfoEdge India. It is, as you know, a listed company which has stake in several iconic consumer portals. They've lost track of who they have stake in, whether it is Zomato or Jeevan Sathi, and I understand even in Legit Quest, which is running this entire event management here. Chintan comes with immense diversity of experience in the fields of consulting, finance, and operations. As a member of the core leadership team of InfoEdge for more than a decade, he has been at the helm of strategy and execution of very many interesting transactions. We look forward to hear from you, Chintan.
Thank you.
We also have Anubhav Kapoor, who is the Group General Counsel of Samvardhana Motherson International, one of the world's largest manufacturers of components for the automotive industry, a listed company, and a prolific acquirer in the Indian space. Anubhav has nearly 3 decades of in-house experience implementing strategic business growth initiatives, managing variety of crisis and change, and overseeing all aspects of corporate governance and corporate legal functions with global responsibilities. Welcome, Anubhav, to this panel. On my right, we have Richa Singh, who is the General Counsel of Medanta Group of Hospitals. Medanta, again, is a listed company in the healthcare space. Richa is part of the senior leadership team at Medanta for more than 15 years and has substantial experience in navigating transactional, regulatory, and governance matters. She was also part of the successful IPO of Medanta recently, and we look forward to hearing from you, Richa. And last but not the least, we have a practitioner with us, Indraneel Ghosh, who is a partner in King & Wood Mallesons with over 12 years of experience across major international fund centers. Indraneel has extensive M&A experience in advising funds and corporate clients on leveraged acquisitions, disposals, restructuring, capital raisings, and joint ventures. We hope to benefit from his international experience, which adds more diversity to this panel. Welcome on board, Indraneel. So since we have, I think, exactly around 47 minutes as per this timer, we thought that we will quickly give you an overview of our preliminary thoughts on the topic as to what we see in the public M&A space, and then move on to the Q&A format. And the topic is very wide, so we've tried to keep the Q&A on relevant and topical issues in this space. I could start. 2023 has been a significant year in terms of public M&A. We've seen a lot of deals, complex deals, and also we have seen a lot of intensity from the regulator itself in terms of scrutiny of deals. If you look at the kind of deals we've seen, we've seen merger of equals like PVR and Inox. We've seen several buyback deals in the listed space. We've seen a lot of block deals, whether it is Zomato or Paytm and the like. We've seen one interesting conditional offer of Aditya Birla Group. Indirect acquisitions like the kind Adani and Ambuja did. We've also seen like a hostile situation which is still going on in terms of the Religare Enterprises and the Bermans. As practitioners, we've also seen several deals which either did not take off itself, even to definitive documents, or deals which got signed and did not finally close, like the Zee-Sony merger. So the experience has been varied, and the key considerations for practitioners like us continues to be the same. Price certainty is important. Deal certainty, and when you start the deal, you have to be certain that it is going to complete. We want no surprises. That is a very paramount consideration for all clients in this space. And more importantly, navigating the regulatory regime is another key consideration for us. In this space, at the diligence stage, what are the insider trading issues? How do you do diligence? What can you share? What you cannot share? And the like is important. At the next stage, what to disclose when you're negotiating? What point in time to disclose? Do you do a two-stage in-principle approval kind of a situation, or you do direct definitive? Make sure there is no leakage. Make sure the deal doesn't get killed because you're talking about listed stock here. That becomes important. Thereafter, the consent regime has also become very complex right now. SEBI has brought in more transactions within the purview of a majority, of a minority consent. So stakeholder buy-in, it's not just two parties who are ever doing a deal. To make sure that proxy advisors are on board, institutional investors are on board, and even the multiple regulators in complex deals are on board, whether it's a pre-consultation with the CCI or the RBI or even SEBI in most cases. This becomes an important consideration in the deal-making space. So we do see a lot of change in the sense that, unlike, say, the Companies Act, which remains constant for several years, SEBI practice involves a lot of change, and we lawyers need to not just know what the law is, but what the spirit of the law is, which different people may have different takes on, and therefore come up with the practice. So that is one of the key challenges in a public M&A transaction. So the deal trends, as far as we see more of the same in 2024. There was a good pipeline in 2023, and we see more of that. The domestic players, we believe, will continue to be more active in this space than foreign investors, unlike the private M&A space. So we do see a robust deal flow in the coming year. Chintan, may I open it out to you on your preliminary thoughts on this?
Thank you so much, for the kind introduction, and you very comprehensively covered what the trend lines are and what it looks like. But I still think that we are still kind of M&A is very at a nascent stage, right? And it's still at the tip of the iceberg. Right? The way it's going to grow, it's going to multiply. There's going to be a multiplier effect, and let me touch upon some of the aspects that you have not yet kind of included in what trends that you pointed out. And one is that if you look at Indian corporate sector, apart from PSU, most of the large corporates, or most 60-70% of the corporates are family businesses, right? They are owned, controlled by family, right? Or even after that, if you look at the next one is the first generation entrepreneur. For them, they derive their identity from the businesses they have built. They have nothing else but to. I remember one of the deal where we were talking, and the guy said, "Look, I know it makes sense to do the deal. Everything is great, money is great, but once I have done this, what else I'll do in my life? This is what I want to do. So we'll think after 10 years, right? So they have that sense of identity, and all those issues come in the way of they agreeing to. So on spreadsheet it may look great, but in reality this may not happen, right? However, the next generation, the second generation, millennials, and we were talking just before this session about how they are very different. They don't mind quickly flipping the business, quickly kind of turning it around, and they are not so attached to it, right? So I think that's increasing, and you'll see that new generation entrepreneurs are now going for so many IPOs. I think that trend is going to increase. If you look at the total number of listing on OTC and SMEs or exchanges, I think that's a fabulous story. So this is going to keep growing. This is going to have a multiplier. It's accelerating. So if you are sitting, let's say, 5 years down the line and discussing on the same topic, you will see a very, very different, volume of M&A transactions that would have been happening in the field. So I think that's an exciting, time ahead.
That is true. I think the emotion behind the public M&A deal has undergone a change with the succession in most conglomerates. That is so well put, Chintan. Anubhav, your views, please.
Thank you, Akela. I think you covered the contours very well, and I'll just extend to what Chintan said and go a little deeper into what the trend lines look like for us. And of course, this is based on publicly available material as well. So if you go by the data, the volumes and the deals went down as compared to 22-23, right? That's what the numbers speak of, right? And this is no different from what the global trends were. And we should not be surprised why it happened because of high interest rates and the socio-economic or the political instability around the world. There were regulatory scrutinies across the different territories. And of course, there was sentiments and that kind of trend led to certain behavioral thing, right? But having said that, the future is still very bright, right? So the trends of 2024, as the future readers read it, is that India still has a very strong economy, almost and a very stable government. The indices are all reading positive. So obviously the trends of M&A are going to be we will see more investments into the country as well. And last year, if you see the inbound investments, the focus has been from countries like US and Germany and Netherlands, and that is not surprising because India focused on technology and energy and TMT sectors, and that kind of increased the investment into the country. And similarly, the outflows also saw a decline, but there was a trend there. I think the Indian businessmen were cautious. There was a lot of deals in terms of volumes which increased in the mid sector, or what we call as 100 million to 1 billion sector. And that kind of is a trend that we see that it will continue, right? And this also shows the cautious approach because many of these trends of interest rates and political uncertainties we are going to see that continue into 2024 as well. So I think on those lines, these trends, we don't see any different from 2023. I think the numbers will speak as we go through the time. But there are also a few other things that we see in the one. Of course, we are going through an election this year, and I think there is a quite excitement about the non-change of regime, and that's what public sentiments are at this point of time, which basically indicates that our political stability is going to be the same. It gives a lot of confidence to the investors, which is a big plus. Also, we are seeing certain trends in terms of the policy shift towards green energy, right? More and more investments are being kind of promoted in the energy sector. So maybe we see more M&A deals in the clean energy sector in the coming future. And also, I think automotive, speaking of my industry, is positive because of 2-3 reasons. One, I think we see the supply chains being reconfigured. During COVID, supply chains got quite skewed, right? That was a very big challenge for all of us. I think we are coming back on track, but this time I think companies are also realigning their supply chain strategies and reconfiguring it. And there are 2-3 trends that we see. One is the China +1 strategy, that you have invested in China, but you want to develop an alternative supply chain based from somewhere else in the world, and this we see globally happening. And similarly, acquisition of technology in certain sectors is driving it. And also the EV trends, right? Almost on a database, we see an increase, almost 45% increase in CAGR in the use of EV vehicles. And therefore, the Indian automotive manufacturers are also building competencies in the EV sector. So, of course, we are excited in the automotive sector that we will see certain more M&As this year. I think I'll just sum up there. It's a positive outlook for 2024, and I think the trends are solid, and let's see what happens. Thank you, Gila.
I think you are in unanimity. I think most people are in unanimity on the optimism as far as the next decade is concerned. And You are in a great sector, so I'm sure there'll be a lot of interesting stuff happening. Richa, your turn to provide us your overall views.
Hi, Akhila. Thank you for the kind introduction. I absolutely agree with what Chintan and Anubhav have said, that I think the trend which we see in not just 2024-25 financial year, but also the next decade, is a very, very bullish trend. It's not only coming from the attitude which investor has, the public has, it is also coming from various factors. We have seen India in the last decade or so globally placing itself in a position which we have never seen India before in. So there is a lot of confidence and a lot of positive energy around India as a space. FDI was happening even before, but now we see investors not even just coming here, but they're coming here strategically to stay and invest and be engaged in the business. Stock exchange is growing. In the last decade, we have seen the NSE and the BSE crossing all the earlier barriers. So the public per se has a lot of confidence in the stock exchange. There is political stability around us, and we are seeing that in the election there is a very positive energy around the same government coming over. So everything together, I think there are all positive and encouraging factors which are showing that the trend is going to be very positive. The regulators, we have seen the regulators not only, and we've seen that in the past the emphasis has been on ease of business. In the last year or so, we have seen that the regulators have come about not only ensuring ease of business, but also balancing it with the protection of the stakeholders, the shareholders. And that balancing act has also boosted the confidence of the public. People have in the last decade or so made a huge amount of money out of stock exchange. That has resulted into this confidence in today's generation that you have to invest and you have to stay in the stock exchange. Everything together, we see that the trend is going to be very good, and that is going to increase the public M&A. Now, coming to the healthcare industry, post-COVID, I think we have seen that healthcare has come out to be a major it's wrong to say as a benefactor, but that's how it stands today. Healthcare has come out as a major benefactor because not just hospitals we've seen, but also pharmacy, also the device industry, the drugs industry, the industry vis-a-vis clinical trials, all these industries, the labs, the pharmas, we've seen in every which way the healthcare has grown. There is a huge emphasis post-COVID, during COVID, after COVID on ensuring healthcare in a preemptive manner. So we see in the healthcare space that there is a whole bouquet of services which healthcare is offering, not just which is basic healthcare, tertiary healthcare, but also a combined bouquet of pharma and drugs and executive health checkups and integrating it with Ayurveda and homeopathy. So it's an endless bouquet of services, and that's why we see a lot of investment in healthcare. That's why we see a lot of IPOs in healthcare. In the last year itself, last year or two, we have seen 4-5 major IPOs in healthcare. And if you see the stocks of these healthcare industries, it is growing. It is growing by multiples. So we see a lot of scope of public M&A in healthcare, and the trend seems to be very positive. So yes.
I completely agree with you, Richa, as in healthcare is very, very active, both from the private equity side and also in the public M&A side. We see a lot of control deals happening in the healthcare space, and completely agree with you. Indranil, your thoughts, please.
Thank you, Akila. Again, thank you for the kind introduction. My fellow panelists have covered pretty much everything that there is to cover about India.
The advantages of being last.
There are. So maybe for the uninitiated, I'll give a little bit of color and context as to where I'm coming from, and I'll talk less about India and a little bit more about the other jurisdictions. So I am a partner at an international law firm which has got offices all over the world, and I am from the Singapore office. So being in the Singapore office, we execute deals around the region. From obviously Singapore, we are in Singapore, but also in markets, emerging markets like Indonesia, Thailand, Philippines, Vietnam. So we have sort of an oversight around all of these economies, and then we get to see how obviously India is such a bright spot in the region, in and around the region, and how everything compares with India. And that's sort of the insight that I'm trying to bring to this panel. In terms of trends, very similar issues that come up in the emerging economies that my panelists have already mentioned. And one particular one is succession. It's a generational thing that we were talking about just before the session as to what the next generation values. This may not be the same thing as the generation that have built up the businesses in many of these economies value. So there's a need for a generational change, a succession case for many of these businesses, and we are seeing a lot of opportunity in that space. In 2023, the deal volume in and around this region has been quite muted because of macroeconomic conditions, the interest rates and inflation, which are all sort of topping out, and they're coming back to normal. And we act for a lot for financial sponsors, private equity funds, and there's a lot of dry powder. So we're expecting a lot of activity in 2024. But whatever we experience here in the region, India sort of is a very bright spot because everyone now the capital that was sort of parked by investors in China is looking for a new home. And top of that list is India. So we are expecting to see a lot of activity in India as well.
Thank you, Indranil. We also hoping that the China Plus One strategy is going to work for us even better than what it has already. Now, moving on to the questions. So the idea is to pick up topical stuff on this space. So each question will not necessarily segue into the next, but kind of give you a flavor on the space itself. Chintan, this is for you. One of the key changes that our regulator has brought about, and it's going to be effective very soon, is for certain classes of companies to make or react to market rumors if they are in mainstream media, and they are obliged to, deny or agree or confirm. You are very active in this space, so how do you intend to deal with it? And do you think this is deal friendly? And do you have any suggestions for our regulator on this? There is a committee, I believe, which is looking at this to see how it can become more deal-friendly.
Yeah. Well, I mean, that's a great question. I think you started like a opening over of, IPL match, just the Bumrah coming and bowling right in. So, anyway, so I don't think there is any silver bullet here. I don't have a great answer to what it should be. I'm glad that they have postponed an implementation of that, because I think that there could be a lot of unintended consequences, right? We really don't know. I understand the objective and the intention behind it, and I think that's, certainly it's a great intention. But how do you really implement that? I think the pluses and minuses both could be different depending upon different cases. So it's very difficult to say that this is how it should be, right? Depend upon what type of rumor is, where, at what stage, the underlying situation is. Is it really going to impact the price? No one really knows what's really impacting the price of, of the stock price. It's very difficult to figure that out, So I think it's a very complex, scenario. But if I have to give one or two suggestions, I would say that, look, let's put it in two different parts. One is the impact on the pricing part, and which is more relevant when there is an M&A deal happening or there's a stock swap happening, right? So I think that's one part of it, right? And it has whatever the calculations that have been given, I think that's all fine. Somebody can look at it. It may not be a perfect solution, but it at least a step in the right direction, I would think. But then there's this other side of, this whole trying to control the insider trading or the tips-based, trading, I think it's much better if I have to, give a suggestion that if there is a rumor in mainstream media, if there's a news item in mainstream media, companies should preferably give a private filing, right? A closed door filing to SEBI, and then SEBI should look at all the aspects of that and then come back and tell that whether it should be made public or not. Because depending upon different situation, it may be advisable to make it public, it may not be advisable to make it public. So if you do a private kind of a disclosure to SEBI, I think there is one more level of filter which people can, which SEBI can look at it and then take a call on saying what they think it should be done.
Oh, that's a great suggestion, Chintan. I think SEBI is not exactly the most consultative regulator, if I may put it, say comparatively speaking to a CCI or some other regulators. So putting them into a consultative mode and trusting them on a private filing and seeing the, as Richa pointed out, balancing the interest between the various stakeholders, because I'm sure doing the deal is just as important for the public shareholders as for the management and the promoters as well. So very, very interesting suggestion. Anubhav, if I can just, kind of shift topics. We are seeing a lot of non-cash deals. We see more of mergers in the listed space than, say, an open offer deals in the acquisition space, like PVR, Inox, HDFC merger, Z, Sony, all of that. And it looks like people are willing to wait for a year for the deal to close. People are okay with the swap ratios that they have agreed to at the beginning. They kind of assume that both companies will parallelly grow on a same trajectory until the end of the year. There is no price revisions after the deal is done and the swap ratio is fixed. We don't see any, top up of the valuation after the deal is done. Though sometimes, it takes, I think, 1 year for PVR to close and stuff like that. So what do you think, I always notice, and I'm very interested in lockbox structures. We try to do that even in private M&A sometimes, but fail very miserably. But in public M&A, lockbox structures have been very prevalent. So what do you think are the key considerations when you go for such a deal? How do you get the certainty and the comfort to go ahead?
I think that's a great question. I think, yes, we have been seeing some increased activity in this space, and there are very good case laws or now experiences, especially in the media sector, right? And this is an interesting space as well, because many of the deals that we are seeing in non-cash sector is because of the coming together of bigger players in that sector to gain more market share or more customer bases, and that itself kind of throws a number of issues in the area of CCI and investor protection, right? So that's one part of it, the regulatory part of it, which is different. But coming back to your question in terms of the lockbox, I think I think these transactions are driven on certain presumptions, right? And those presumptions are agreed right in the beginning, and I think more than that, there's an appetite on both the sides to kind of take some swings in the valuation, right? That's more or less how you freeze onto a certain valuation or swap deals or whatever the value or the valuation numbers, right? But and that's not the bigger problem, right? Because at that point of time, you are showing them the performance, you are showing them what this business is all about and what is the future potential, and that part is more or less relatively easy in terms of what comes next, right? Now, you do the deal and then you wait for 1 year, right? If you're going through an NCLT process, of course you are now subject to scrutiny of other details as well, right? And then you also start in parallel the due diligence process, right? And that's where the details start coming out, right? And of course some deals are negotiated with some post due diligence adjustments, but more or less what we see 3 or 4 areas where the problems start coming in. One is, as you discover or make more the due diligence reports come out, then you know the health of the company, right? In terms of the regulations and in terms of how the company has been performing. Second is on the financial performance, because over a period of time, if if the company is not fundamentally strong, I think there is a shift in the financials, and it could be both positive and negative, right? If it is negative, of course the prices have to be adjusted, and that's where it causes certain issues, right? If it is beyond the thresholds that you have already agreed to. But if it is positive, then it's the expectation on the other side, right, which could create some issues as well. But I think because there is a commitment, things don't go south too much unless the variations are too much, right? And that's where the problem starts, right? And the second also is the expectation of the promoters, what they want to. People can change minds in terms of what they want to do the business in a period of 1 year, because and that is the second area where we see people just change the directions and the intentions change, right? And that is where we see another litigation issue or a renegotiation point where it is. On the regulatory side, I think the period of 1 year is quite large, especially when we go for these deals that have happened in the public space, the PVR Inox, or say, for example, I think the Z Sony is a classical case in terms of where it was complex right from the beginning. Regulators supported it quite a bit, but then later I think it didn't really go through, right? But it had few lessons in terms of what we could learn. First was, in fact, the structurings have become quite complex, right? And the creditors, and there is a lot of shareholder activism in terms of how they want to see their returns go up in such deals, because this is sometimes the merger of equals, right? And both have large negotiation power over each other. So this is a trend which we have not seen before, and so there is a lot of value creation that is in the stake. Second, we see regulators now kind of becoming facilitators, or I would say they are trending towards smartness. It is not a uniform experience, but then, say for example, in the Z Sony case or in the Inox PVR case, we saw actually CCI taking very firm stands and not getting into a probing situation, or there were complaints filed under CCI for both the deals because of the dominance that the post-merger would present. But I think CCI took a very practical view in terms of facilitating, and they held the shareholder interest in the fore, which is the basic principle of corporate governance, right? So I think those trends were very, very welcoming, right, in terms of, and also the third part I would say is the NCLT part, which I think is the most complex, because it kind of concludes, but if you could shorten the period a bit, that would be a welcome move, but that is what it is right now. I think those are some of the challenges that we see, but it's a healthy trend that in terms of the risk appetite of people is increasing, and shareholders are becoming much more smarter in terms of what their interests are, and also the corporates are willing to dive into more riskier kind of investments to enhance their returns. So I think I would say it's a positive trend, though it has its own pluses and minuses.
No, you're right. I think these complex transactions require an appetite and a long view of things, and that's the only way you can kind of deal with it. And it's interesting that more compliments have been showered on CCI, and I completely agree. But we also see that nowadays the regulators are also very savvy in terms of talking to each
Very
other.
savvy, yeah.
Earlier, regulators did not talk to each other. Even the different departments of SEBI did not talk to each other not so long ago. But we see now more concerted action, which could be good and bad. Moving on to you, Richa, I have a different question for you. You already alluded to how good our stock market is doing, and how investment in stock market is a done thing now. And your company has successfully IPO'd and also given good exits to some of your institutional investors. And we see this as a big trend that, earlier when we used to do shareholders agreement and look at exit options, IPO used to be one exit option, but nobody really believed in that exit option much. So, trade sale, buyout, put, call, buyback, those were more of the exit options that were tried and tested, and IPO was something you aspired for. But that is really changed, and you are again one of the poster boys on that. So do you think this will continue? What do you think that are the key challenges in using IPO as an exit for your investors?
So definitely, I think the trend will continue. And in the initial discussion, I think we have covered all the points as to why this trend will continue, from political stability to the economic growth to the successional change to the change of mood, the public sentiment, and all of that. So definitely, this trend is going to stay there. As far as IPO being a successful now, considered to be a successful option for exit, I think that will continue because we've seen the way the market is showing the trends. Depending on the market, I think IPO is going to be that strategy. Earlier, the market was used to be volatile. We have seen situations where the market has gone up, been bullish, been bearish, and because of which IPO was never considered to be as a very stable exit option. But considering the last couple of years, I think IPO will continue to be a good exit option. As far as challenges are concerned, for any entity to use IPO as an exit option from a private company perspective, the challenges would be to ascertain the price. I think as far as the base price is concerned, the floor price is concerned, valuation is concerned. From a private entity, the valuation is considered, using the accounting standards, there is a lot of variability in this valuation. You go to different valuators and different valuation will come in. But when you actually go to the floor and actually go for a bidding to the IPO, the listing will have a completely different valuation. But while after the IPO, I think the M&A space, the public M&A space, the challenges would be, we will see that if today I decide to do a public M&A in this space, my biggest challenge is the regulatory regime. The regulatory regime, the disclosure regulations, the amendment to the Regulation 30, LODR, and the insider trading regulations, the amendments that's come in there, that will pose a significant challenge for me as a listed company today for any public M&A. Because today we are in a fix of what information to disclose, to what extent the information has to be disclosed, how it will impact the price, whether it will result into a price uncertainty, whether it will result into a price fluctuation, and how will it impact my deal. And whether due to this price fluctuation, whether the deal will continue to live or whether it will collapse, that will have a significant impact. Because when we look at the aspects of any public M&A, it is heavily regulated, it is heavily supervised by the regulator, whether we are talking about the SEBI, whether we are talking about the CCI, whether we are talking about, in case of any foreign investor involved, we are talking about the FEMA, it is heavily scrutinized by regulators. Whether we are talking about each step of the transaction, whether it's a due diligence, definitive agreements, or the closure, there are a lot of compliances and a lot of filings, and there is a lot of public glare in that and public involvement in that. I think that regulatory regime and the focus of regulator on these transactions will act as a huge challenge for any public M&A. So I think that's what.
Thanks, Richa. I think while IPO is a good option, it is not as easy either, as you kindly mentioned. Chintan, what do you think, from an investor's perspective, do you think it's as easy as people think to just IPO your investment, or?
Yeah. So IPO is certainly, it's a great option, like she kind of clearly mentioned all the advantages of that. But let me talk about the companies which are not necessarily IPOable. Right? Not all the startups, not all the companies are IPOable. There are very different types of models that exist. For example, if you look at all these SaaS companies, which are mostly in Bangalore, around Bangalore area, right? They all kind of build a product. They know that where the tech, product gaps are in some of the large companies. They build the product, and the whole idea is to sell the company. It's never about building a business. It's always about selling the company itself, right? You create a brand and you sell. You create a product and you sell. You just have some POC, you look at some Indian customers, some US customers to show that the product is working, you sell the company. So what are the things that can be done as an ease of business for the companies which are not necessarily IPOable, right? One of the things that comes to my mind is the carry forward of tax losses, right? Because initial years there are losses that are built into it. And if you see, there are certain enabling provisions in IBC to get this advantage of tax losses. In fact, the Air India deal, government itself gave some, made some exception to that. I think that something can be institutionalized, and some of those type of, provisions can be brought into statute. People go through the NCLT process only so that they get the tax exemptions, right? So you can reduce some of that part of it. I'm not saying that all types of cases you remove the NCLT, but at least in some cases you can make it more administrative, you can move faster, So I think some of those kinds of aspects can happen, and then you will see a lot more. I mean, let's take another model which is build, operate, and transfer. Right? It's the BOT model, which is talked in the parlance of infrastructure, but it's possible also in the tech sector. We have tried one or two of our investments are of that nature. That we'll invest, you build it, you operate it. After some times, we'll buy back. I think Carrot Lane was a kind of a case in point. If you look at Carrot Lane, I think that's how it was. That Tata Titan finally acquired it, but they asked them to operate for some time, and then they eventually bought the balance 30% stake. So I think there are different models, and the ease of doing those type of models are also great. And then if the non-IPOable type of companies also flourish in the economy. And another point is that if you look at the pile of cash that all the corporate guys are sitting on, right? Look at all the IT services company, they have so much of cash that's lying with them, right? And dividend is not tax friendly. So if we can really make this workable, I think it will be great for Indian economy, great for startups, great for entrepreneurship.
No, I think again a very interesting suggestion. NCLT is burdened. Corporate taxpayers are burdened with the tax. If they can just come up with a solution, it's a win-win in terms of administrative burden and maybe some tax benefits. Completely agree with you. Most times you're doing that 12-month process only for tax and no other reason.
12 months is very aggressive.
Very,
very ambitious.
No, it's happened. I have precedents. Okay, Indranil, over to you. I think you've heard a lot about India shining, and you also mentioned that we are the bright spot in the region. So how do we compare with other emerging markets? Like you said, we are top of the line for China +1. But we read different reports on Vietnam and Indonesia and other emerging markets. So since you are in the region doing deals, is ease of doing business good in India?
Yeah, so in terms of ease of doing business, in terms of the regions or the countries that we work with in Asia, so I would divide it between two broad categories. So one would be Singapore, Hong Kong, Australia, and to a certain extent Malaysia. And the second category will be the more emerging economies like Indonesia, Vietnam, Thailand, and the Philippines. And so I would place India right in between these two categories. The bucket one category, so to speak, the public M&A laws are if I may use Anubhav's words, more facilitative. So the laws are stable, are more efficient, the systems are more transparent, the regulators are more pragmatic. So overall, they're facilitative. While for the bucket two countries, the regime is disruptive in their own unique ways. So if I take the example of Indonesia, the laws, the takeover, the public M&A laws, laws generally are ever changing. And the securities market regulator, the OJK, has an outsized role in interpreting the laws as they are changing, and in many cases they are unclear, and in many cases they are laying down laws which are not actually written down. So there's not only do we have
all sounds familiar, yeah.
Yeah, not only we have to look at the laws that are laid down in statutes, but we also have to know what the unwritten rules are, what the market practice is. So it's challenging, and in terms of the substantive law as well. So if you take an example of squeeze out, none of the bucket 2 countries have compulsory squeeze out laws. But so, for example, in Indonesia, not only do they not have squeeze out laws, but if following a mandatory tender offer, if the controller reaches a threshold of 80%, then there is a sell down obligation. So the controller has to sell down in a period of 2 years until the public shareholders hold 20%. So the law substantively, actively discouraging a squeeze out. Even then followed by delisting, you need a GMOS, which is the shareholder approval, to get the delisting done, and that's approval of the independent shareholder. So at the point you're trying to do a delisting, you are around 85%, 90% of the company. So you would need the approval of the 10% to actually get it done. So the law itself is saying that no, you can't do this. They're quite disruptive, and when you compare it with the regulators in India, I think you made the point that they're being more progressively more facilitating. That's a change that we haven't really observed in the jurisdictions that we work in.
Oh, that's interesting. That's very interesting. Thank you for that. Moving to you, Anubhav. I think we cannot have a panel without mentioning AI or ESG. So I choose AI. We all discussed about different viewpoints of different generations. Do you think AI is going to play a big role in M&A transactions in the years to come?
Akila, both my questions are futuristic, right? So I take that liberty. Yeah, I think I'm a technology pro guy, so I'm very much optimistic. The M&A processes are going to change and to the extent that it will revolutionize how we do M&As now in the coming 5 or 6 years, right? And we are not too far away from what we may think right now is the state of AI, right? And I think the generative AI space and the training of the machines and the ML languages are developing extremely fast, and our machines are getting smarter much more faster than what we think, right? And while this is a general answer, let me give some substance to what I'm even saying, right? So in a M&A process, if you break down the whole process, let us see where AI can really be helpful, right? You start a M&A process with screening of the industry or screening of the company to do research, and I think a generative AI can very easily get to the public's available information and produce a report, and that's something that will be very useful for us. We may spend more money now in terms of doing those kind of researches, so that is something which generative AI can facilitate. I think the deal sourcing or deal screening kind of thing, who is your best target among a choice of targets, probably is something AI can do very well. And the predictive modeling that we are seeing in AI algorithms, I think is certainly going to help us make those choices much smarter and in a more data-driven way, right? And I think the due diligence process is where the whole focus is, right? You talk about AI in M&A and they all talk about due diligence. I think it is the screening and the search of the documents and the way you can find the differences between the two data points that are there. I think the machines can do it much more quickly and more in a more smarter way than human efforts. And certainly that is one large area where the productivity, the use of time can come down, and certainly I think we can see some cost savings there big time. I think the even AI can be used for, say, synergy identifications, cultural synergies of M&A, because it can process much more data points in terms of if we have the right data for different organizations, then I think that is one area where AI can certainly help, which is very subjective, say, in case of human reasoning, right? So I think even after post integration or post closing, I think AI can be very well and effectively used for performance management or assessments and things like that. So I think there is a lot of reason why people think that M&A processes will be revolutionized by the use of AI. But let me come to the reality, right? The reality is, one of the surveys that I went through, only 15% of the population right now uses AI. But it is envisaged.
Most of them are students.
Yeah. So, but it is envisaged that it will be 80% 5 years down the line, right? So it is basically hype at this point of time with a very large hope for the future, right? So I think I'll summarize my thing with this statement, and I'm sure, and the challenges right now is the availability of the data, right? And there is still not much confidence in the accuracy of the results of generative AI. In fact, many of the people say we spend more time reviewing the output of AI rather than it is easier to do it ourselves because we know what the data points are, and that is a real threat right now because we don't have controlled data environments in generative AI unless you create a private AI, generative AI system for yourself. So I think those are some of the imperatives. Right now, I think there is a large hope, but actually on the ground, very few people are using it. The use is more towards document search and maybe part of the due diligence process. That's the limited use at this point of time. But maybe 5 years down the line, we'll talk a different language. Thank you.
I completely agree, Anubhav. I think apart from diligence and maybe some rudimentary drafting and research, we've also not seen much use. Hopefully, that hype will become hope very soon. A question for you, Indranil. I think you already mentioned that, in fact, India is faring better than, say, Indonesia in terms of at least the delisting and squeeze-out regulations. But the view here at the ground level in India is that our regulations as far as delisting is concerned is pretty not, investor or promoter friendly. And once you list, it's pretty much impossible to delist. And if you're an MNC, all the more reason because a lot of speculative trading. Any quick suggestions? I noticed that time is up. Any quick suggestions that you may have for how we could basically amend our delisting regulations? There is a consultation paper out, but any suggestions from an international perspective?
I think it's just the need of the hour is to simplify the legislation around pricing and to make it effective, it needs to be done as a package so that you can take private at one go rather than in different stages. So if the law can cater to that, then that would be great.
We do have that, in fact, in our tender offer regulations, the takeover code. We do have the option to take it private in one go. And in fact, we recently tried it with one of our clients, our systems. But it's still not really successful because you have to do a fixed price offer. Yeah. And there are no takers because of the availability of that other regime. Yeah. People who buy in at a later date don't tender and you don't reach the required thresholds. But yes, price is the key element. Yeah. Thank you. Just one last question to you, Richa, on stakeholders. As in, I think now you're a recently IPO'd company, and you rightly mentioned that there is more on your plate in terms of stakeholder buy-in. One important animal is the proxy advisor firms, and depending on who you speak to, they're either conscience keepers or mischief makers. Which is your point of view?
I think growingly there are going to be more conscious keepers. Currently, maybe mischief makers because they are there to establish their presence that yes, we exist. They do not have skin in the game. they definitely have all the resources and everything to analyze the sector which they're talking about, the stakeholders there, the business and all of that. So they have all the right resources to give the right advice. But currently, I think because they do not have the skin in the game, and maybe because also there is a definitive possibility of a bias and conflict of interest. So, but growingly, I think in future they definitely will be conscious keepers, and we will see that shareholders and institutional investors and everybody relying more and more on their opinion and advisory. But yeah, that's what I think.
They need to be regulated.
They definitely need to be regulated. They definitely do before they become an animal.
Thank you so much. Thanks everybody on the panel for your very interesting and very, very diverse views, I thought came from both directions. Thank you, ABA, for organizing this and having us here. Thank you, audience, for a very patient hearing.
South Asia Committee of the International Law Section presents the Global Lawyers Summit in association with CNBC TV 18.